All right, welcome back to another edition of the Financial Accounting. We're going to continue on into Chapter 8 here. We've got our exam coming up next Friday on April 2nd. That's a pretty hard date there, so I don't expect to move it anytime soon. On Thursday, you'll have 8.1, 8.2 homework due. Friday, we'll talk about 8.3 and we'll get into 8.4 to some extent. I'm not sure how much we'll be able to finish. But we'll definitely finish up 8.4 on Monday with the remaining portion of Chapter 5. Review is next Wednesday, so just make sure that you're coming to class having read the book. Get ready to ask me questions if you have any. I'm happy to help out wherever you need it. And just as a reminder, we've got our extra credit project up on my accounting lab. That takes a little bit of time to get to speed, but remember, you need to get at least 70% of that project correct in order to get some amount of points. So you'll get at least 14 points. You get up to 95%, you're good. That's a full 20 points right there. Some people, they get upwards of like 91, 92, and they call it quits, and then that's fine. That's going to get you 91% of the points. But if you get up to 95 or above, I'll give you the full 20 points extra credit. So make sure you jump on that as soon as possible. One thing I can say about the extra credit project is that usually about this time, people are starting to say that the material is starting to click a little bit. They're starting to understand it better. If you do the extra credit project, most people will say that it really sort of solidifies what's going on in accounting. So it's there to help reinforce some of the things that you've been reading about and learning about in class. And for a lot of people, for anybody out there who's still struggling with material, that's a great way to sort of kind of see the material from a different perspective. And it will likely help you. It will definitely help prepare you for the final exam. So just remember, this is due on 420. It's due on April 20th. So you have a little bit less than a month to get done. I recommend just start poking around in there as soon as possible because that deadline comes up pretty fast, and I don't want to leave anybody of you guys behind. The material we covered today isn't very long. 8.1, 8.2, a lot of concept questions. We'll talk about some of the calculations you need to worry about for the sake of the exam. And a lot of what we talk about in what we see in Chapter 8 in general, you've seen before to some extent, especially from Chapter 3 and Chapter 2. So it's just good to sort of, solidify some of this knowledge to make sure that you're going to do well in this exam. 8.1 talks about distinguishing current from long-term liabilities. Current liabilities are those debts that generally we expect to pay within 1 year. The definition goes on to say within 1 year or one operating cycle, whichever one is longer. Generally speaking, it's within 1 year. Very, very rarely do you see any companies out there who have an operating cycle less than 1 year. So primarily we're talking about the 1 year cutoff mark. Is something I'm going to pay due within the next year from the balance sheet date? If so, it's a current liability. And the key thing to realize is if we're talking about a 12/31/2020 year end, at that point, we look ahead. These are eyes. We look ahead for 1 year and we say, okay, by the time we get to 12/31/2021, how much of our current debt, what debt as of 2020 year end, how much of that debt is going to be paid off within the next year? If we pay off any amount of a debt within that next year, regardless of what it is, if we pay off any of that debt, any of those payables within the next year, that's a current liability as of 2020 year end. So the key thing here is we're talking about debts that are most of the time associated with day-to-day operating activities. If we're in the business of making pizzas to generate revenues, what are all the different debts associated with just making pizzas? Salaries payable is a classic example. If a debt is due within a year or less from a company's balance sheet date, it's going to be classified as a current liability. So you may recall from our second exam, there was a question about notes payable. Notes payable, generally speaking, is a loan from a bank that's due within several years in the future. But it's possible, as you know by now, it's possible to have some portion of notes payable, or maybe all of it, due within 1 year. If that's the case, we need to make sure that notes payable is classified as a current liability if it's due or it's going to be paid off within the next 12 months. So watch out for that. Something that these concept questions, they tend to get people on the exam. So 8.1, 8.2, full of a lot of concept questions. That's usually one that tends to show up on an exam pretty frequently. If a debt, though, is due more than 1 year from a company's balance sheet date, it's going to be long term. And just kind of the same idea about notes payable. Don't get too wrapped up in the title of the account. The real question is, when is that debt going to be paid off? Unearned revenue, recall, unearned revenue happens when somebody gives us a cash deposit in advance of receiving any services or goods. So unearned revenue is a liability. When they give us the cash in advance, if we haven't performed any services or we haven't delivered any goods, that's a liability at that point. The question comes down for us for this chapter is, when do we actually recognize it as revenue on the income statement? If we don't recognize or perform any revenue generating services or deliver any revenue generating goods until say like 15 months in the future, this sucker is going to be a long-term liability. So the key thing here is when you're reading through any of the problems, especially on this exam, please pay close attention to the dates. It's the date we pay things relative to the reporting date, the balance sheet date. That's what we want to measure. If we don't pay things until it's 2 months in the future, it doesn't matter what the account title is. It's going to be a long-term liability. So just be careful about that. Most liabilities tend to be current liabilities, but you just want to pay close attention to any date so you don't get hung up on any. I'm not going to try to trick you on the exam. I just want to make sure that you know, hey, if I'm going to pay it within 1 year from the balance sheet date, that's current. So just watch out for those things. Liabilities come down to two different kinds. There's the accrued liabilities and the deferred liabilities. Most of the liabilities are accrued liabilities, meaning that we are recognizing something now. Usually what we record right now is an expense, say for like salaries expense, right? Or any type of taxes payable, tax expense. We pay cash later for those. So we're accruing right now. We're bringing it on the books right now, even though cash hasn't been paid. Accounts payable tends to be the biggest liability that we see. And generally, it's related to any type of inventory acquisition related activity. So if we're purchasing finished goods or even for just purchasing raw materials, generally speaking, we have accounts set up with our suppliers and our vendors and our manufacturers. Those people will tend to send us the goods that we need right now, and they'll bill us later. If we do regular business with these types of suppliers, we'll have usually an account payable set up with them. So accounts payable generally related to the operations of what we're in. If we're in the business of making pizzas, hey, we've got an accounts payable with the suppliers of our flour, the suppliers of the meat, the vegetables, anything that goes on to the pizzas. We'll have a relationship with those suppliers. And we'll have accounts payable set up with them. Notes payable and bonds, those tend to be long-term in nature, basically meaning we're borrowing money, we're going to pay it back in the future. So that's how we get into that debt. Any type of interest payable is usually something that we pay off within a month. So we tend to accrue interest at the very least 1 month out from the actual payment date. Income taxes payable, generally speaking, those are current liabilities. There's only been some cases where I've ever seen an income tax payable where it's long-term, and that's usually because the tax payable is in dispute with the government agency. Most of the time, though, income taxes payable are all short-term. Warranties payable tends to be a little bit tricky. If we offer a 1-year warranty on goods that we sell to our customers, those warranties by virtue are going to be 1-year payables. And we will talk about how we estimate those warranties. If a warranty is like a 2-year warranty, then some of that payable will be considered long-term and some of it, the rest of it will be considered short-term. So it's really a matter of like, when do we expect to see these claims filed for people come back and say their stereo's just jacked up for some reason. You might see in a 10K this item called other accrued liabilities. It seems sort of like nefarious. Ooh, it's this other liabilities. What could it be? It's generally just a bunch of small balances. We can have lots of T accounts, lots of accounts that record things that we owe people or other organizations, but it's not worth listing every single frickin' account. So those accounts that tend to be really small, they're generally just considered miscellaneous balances we owe. There's no need to list those outright. We'll just sum them up and call them other accrued liabilities. The one liability that tends to cause people the most trouble is this unearned revenue. As I talked about before, it's basically a liability that arises because we got cash now. We got cash in advance of performing services or in advance of selling goods. So this is a deferral in the sense that we're deferring revenue. Cash was received now, but we push off the revenue recognition. We defer the revenue recognition into the future. So just realize that generally speaking, most liabilities tend to be current liabilities. Those that are long-term generally are going to be called like a notes payable or bonds payable, but you want to be careful. Be careful. Look at the date of when these liabilities are going to be paid off. If you need to make an assumption on the problem, assume that liabilities are all due within 1 year unless you get some sort of additional information. Accounts payable. So there's a lot of concept questions associated with just current versus long term. You just want to watch out for the dates that those liabilities are going to be paid off. Usually I ask a question on the exam about estimating purchases. Companies don't disclose how much in inventory they purchase. They do report on the balance sheet how much inventory they have at the beginning of the year, how much they have at the end of the year, and they also report cost of goods sold. So in chapter 6, we went through this this cost of goods sold model where we said beginning plus purchases minus ending equals cost of goods sold. And the problems you worked on basically gave you these pieces of information, or you had to somehow make an estimate of what ending inventory was given that there was a fire or something like that. Purchases were always given to you in those problems. In reality, unless you work for that company, you don't really know how much a company purchases of inventory. You can, however, based on the information you do have, make an estimate of how much a company purchased in inventory in a particular year. And we'll go through some examples. The reason why we want to know about purchases is because if we're going to analyze how well a company pays off its debts, we want to calculate a couple different ratios. One is the accounts payable turnover ratio. It's very similar to inventory in the sense that we figure out how much a company builds up into its accounts payable and then pays it off during the year. So if a company, say, builds up its inventory and pays it off 3 times during the year, it means roughly about every 4 months, it takes 4 months to pay off an average accounts payable balance. We'll talk more about that in a second, but it's similar to inventory. And the inventory turnover was how many times do we build up inventory to an average level, sell it all, build it up, sell it all. So these concepts, these two ratios, they're very similar to what we've seen before, but we're not talking about inventory. What we're talking about are payables. How much do we build up as a debt to somebody we owe, and then how quickly do we pay it off? That's what's going on in this case. So the accounts payable turnover. In the accounts payable turnover, we're trying to determine how many times a company is able to pay off its balance of accounts payable. And what we do is we take the number of purchases during the year and we divide it by average accounts payable. The purchases, when we're doing purchases, remember that purchases, we debit inventory and we credit accounts payable. That's the journal entry. So inventory, this is for the purchases. When we're building up our inventory, it means we're making purchases. We don't see that on the company's financial statements. We can make an estimate of that, though. If we look at the total purchases and divide it by the average accounts payable, we can determine how many times they build up their debt, pay it off. This is good because we can determine how quickly the company can pay off its debt. If a company takes a long ass time to pay off its debt, that's a concern for us. So the more times it builds up and pays off its debt, generally that's a good thing. For me, if you looked at my credit card history, you would see that every month I'm paying off my balance, build up a balance, pay it off, build it up, pay it off, build it up, pay it off. So my AP turnover would be like 12, meaning that I pay off my balance, my average balance 12 times during the year. If it's less than that, it means I probably skipped a credit card payment. Not a good thing. So that's a good ratio to calculate for a company, but also you'll see how we compare that to other competitors to see which one is better at paying its debts. Companies don't report the purchases. So recall, here is the equation we're used to seeing. Beginning inventory plus purchases minus ending gets us cost of goods sold. We don't know what purchases are just by looking at financial statements. Like if we go to the SEC's website, we won't be able to see that. But we can see when we pull down their financial statements what their beginning inventory was, their ending, and their cost of goods sold. So if we just rearrange this equation, we can calculate purchases. So that's a key thing that you want to be able to do for the sake of the exam. The days payable outstanding is similar to the days of inventory outstanding. We're basically just taking 365 and dividing it by that AP turnover that we computed above. That actually provides us a little bit more of a meaningful number because it tells us how long it takes a company to pay off its debts. We want to see it paying off its debts quickly. If it doesn't pay off its debts quickly, could mean that they may have a cash flow problem. Who knows? But there's a lot of things we could, suspect. So let's take a look at Amazon. A lot of people have Amazon accounts, Amazon Prime. They're a publicly traded company. You can pull down their financial statements and look into the company and see what they do and see how well they're performing. It would be interesting to do that. And we don't have time to do that right now, but if you get a chance, you can actually take a look at Amazon's 2020 performance and compare that to its 2019 performance. You will see a huge spike in its revenue in 2020 because people stopped shopping in person. They prefer to buy through Amazon online. That's not surprising because we're in a pandemic. Here, I'm just going to take a look at the data from 2016, 2015, and 2014. And just to see how quickly Amazon pays off its debts. Based on the financial information that I can pull down from the SEC's website, I can look at the income statement and see in 2016, they had about $88 billion in cost of goods sold. I can look at their balance sheet and figure out what was their beginning and ending balance of inventory. If I use that equation from up above, I can determine that roughly Amazon in 2016 purchased about $88.5 billion in goods, merchandise. Okay. Purchased about $88 billion, sold about $88 billion. So it doesn't leave stuff hanging around. It's very tight with its inventory management system. If I compare that to the prior year, I can estimate that over time from 2014 through 2016, Amazon's been growing. They were growing their business. They were building out Amazon delivery spots, their warehouses. And as a result, they're stacking up their inventory. They're building up their inventory more and more and more every single year. Just take a look at how the ending inventory balances have been increasing, right? So in general, a company is growing. We expect to see their ending inventory balances growing. We expect to see their purchases growing. We expect to see their cost of goods sold growing. So all these things have got to make sense. And if you see things not moving in the right direction, you have to ask yourself what's going on. But generally speaking, the numbers tend to match the reality. If I were to look at purchases for 2016 and I were to divide that by Amazon's average accounts payable, this is something I would pull down from the balance sheet. Just look at their beginning accounts payable, look at their ending accounts payable, divide by 2. Simple average. Okay? I would calculate an AP turnover of 3.92. Okay, roughly about 4. Okay, which means that if you were to interpret this, it would mean that Amazon, in a 12-month period, in a 1-year period, builds up its inventory, builds up its accounts payable, pays it off 4 times during the year. So if this is 1, 2, 3, number 4, basically it pays off all of its current liability, it pays off all of its accounts payable at least 4 times during the year. It means roughly it takes about 3 months. They build up their accounts payable for 3 months and then they pay it off. So it takes about 3 months. You can sort of that's the imagery I'm seeing when I read this. But to verify that, I would want to take 365 days and divide it by the AP turnover And so when I do that, I get this days payable outstanding of 93 days, which is roughly about 3 months. It takes Amazon roughly 3 months to pay off its accounts payable. Now, Amazon, if we pulled up the 10K, we would see that Amazon has got a lot of money. So why the heck does it take them so long to pay off their debts? It's an interesting question, right? I mean, they're a big company. You can see that this practice has been going on year over year over year. In fact, it's interesting because in 2014, it took them 90 days to pay off their debt. 2015 took them 91, 92 days, and now they're up to 93 days. So it's taking them longer to pay off their payables. Why is that the case? The company isn't strapped for cash. Here's just the imagery of what we see going on. And just as I'm just making a point here that inventory turnover and days inventory outstanding, it's similar to the AP turnover and the days payable outstanding up above, and that we see them moving in opposite directions. If the AP turnover is, say, 4.03, which we see it in 2014 there, the 365 divided by a large number gets us a small amount, a small number of days. So the more frequent we pay off our debt in a year, the shorter the amount of days. It means basically it's correlated with each other. But over time, right, Amazon's taking their sweet ass time just trying to make the payable happen. So it's just curious because it's a trend that keeps going that way. They move in the opposite directions, just like we saw in the inventory turnover ratios. So we can look at these numbers and say, well, how do we interpret them by themselves? I mean, that's the first step you want to do is figure out what the heck does it even mean. Then you want to compare it to other competitors to see if it seems reasonable. So there is a fairly objective way to evaluate what's a strong or weak ratio. Generally, a high AP turnover ratio is better, meaning that we're building it up, paying it, building up, build up, pay off, build up, pay off, build up. The number of times we pay off in a 1 year period, if we pay it off frequently, the number of times we pay it off, that's a good thing. It also means that these payment periods are very, very short, very, very short. Compare that to somebody that takes a long time to build up, pay off, build up, pay off. Those durations are very long. So smaller turnover ratio is not good. Smaller turnover is correlated with a long period of time to pay off your debts. Pay off your debts quickly, you're going to have a high turnover ratio and a short days payable outstanding. So they work together. Typical credit period is 30 days. Amazon's is 90. What the heck is going on? Likely, and this is just my theory about this, Amazon tends to stretch out their payments for 90 days. Now you got to think about this. Amazon likes to pride themselves after helping small business owners sell their products. Fine. Amazon reaches out to a small business owner. Hey, you can reach a broader audience if you sell through us because, hey, we're just a gigantic channel of just selling products. They're just a middle company, right? So if the supplier sells products, Amazon will sell it off to the customers, a broad customer base. That's very attractive. Amazon collects the cash from the customer and typically takes a little bit of a commission fee for doing this and is supposed to remit the remaining balance to the supplier, the manufacturer, the small business owner. But here's the thing. Amazon collects the cash and immediately records a payable. Think about this now. They are acknowledging once they make a sale to a customer that the cash they receive, most of it belongs to the supplier. Why doesn't Amazon just automatically send the cash to the small business owner? Well, likely because they invested. Huge companies, I mean, we're talking like billion-dollar corporations, even Nike, They have finance departments, and their sole job is just to manage their excessive amount of cash on hand. Billions of dollars these companies have in cash. Why remit it right away to the supplier? I mean, legitimately, it's owed to the supplier. Why remit it right away when you can hold on to it, say, for 1 month, 2 months, 3 months, invest it during that time period, generate a little bit of interest income, put it into some money market accounts. Most companies have a sophisticated investment system where they will take their cash overnight, and they will automatically have it swept into a money market account, have it invested in markets overseas, like the Tokyo Exchange. And then at the close of that, the start of business day here in the United States, the money plus interest will be swept back into the bank accounts of the corporations. That's overnight. Amazon doing this over, say, 90, 93 nights, that's a lot of money that they're generating. So the key thing to realize this here is that it doesn't make sense to pay off your debts right away if you can use that cash in the meantime to generate a little bit of interest income. Okay. Now, that's suspicious to me. I look at that and say, number one, I don't want to wait 3 months to collect my cash that I'm owed. But is that necessarily a bad thing? Let's take a look at other companies here. We've got Amazon, then there's Walmart 2016 and Target 2016. Basically, they're competitors with each other. Okay. Which one would you rather do business with? Amazon, Walmart, Target. Okay. Keep in mind, and we're talking about doing business. Imagine you're the small business owner. We already calculated a turnover, AP turnover with Amazon of roughly 4. It takes them they pay off their debts 4 times during the year. Compare that to Walmart. Walmart pays off its accounts payable 9 times during the year. That means when you sort of compare Amazon's wheel, right? Amazon will turn over, pay off its debts 4 times in a 12-month period. But you look at a company like Walmart, they actually have a bigger wheel. How many times do they spin around? How many times do they turn that wheel over? They turn it over 9 times in a 12-month period. So I'm spinning, making 4 revolutions in a 12-month period versus 9 revolutions in a 12-month period. Which one is going faster? Which one is paying off the debts faster? It's got to be this guy. They're spinning the wheel 9 times versus over twice as fast as you see with Amazon. Does that make sense when you look at the other ratios? It does. You take we already calculated a 93-day period to pay off its accounts payable for Amazon. Take that 365, but you divide it by 9. Walmart pays off its accounts payable in less than half the time. So, which one takes less time to pay off the payable? It's Walmart. For me, and then you can look at Target and figure out that's 55 days for Target. It's still faster than Amazon. So if Amazon came up to me and offered to sell my shit, and then Walmart and then Target came up to me and they offered to do the same thing, which one would I rather go to? Probably I want to go to Walmart or Target over Amazon, because the moment Walmart sells my products, I only have to wait 40 days to get my net proceeds. Amazon will take their sweet ass time, take 3 months to remit to me the cash proceeds from the sale. Think about that. I get cash from a sale that happened 3 months ago. 3 months? I don't want to wait 3 months. Give me my cash now. Also keep this in mind too. The size in 2016, mind you, we can take a look at Walmart and compare it to Amazon in 2020, but the payable, Amazon in 2016 had an average accounts payable balance of about $23 million. So the size of its wheel, if you think about how long does it take, the size of its wheel, right? Again, this is just the imagery. They essentially build up their inventory, build up their accounts payable, and then sell it off. Think about that circumference is like 23 billion, right? And it takes them about 3 months to build up that payable and pay it off. Compare that to Walmart. Walmart's accounts payable is $40 billion. So they have a big wheel circumference. You start up here, it goes around, right? They build up around $40 billion of accounts payable, but they pay that off in maybe a little less than 1.5 months. So Walmart is much more efficient at paying off their payables in terms of a time period. But not only that, I would also look and say they're also paying off huger amounts every time they pay off their debt. You think about the payables, the payable turnovers, realize we're talking over a 1 year period or 12 months. Amazon is building up their accounts payable to about 23 billion. It's just an imagery. So this is not actually what's going on. This is the imagery I want you to take away. They build up their accounts payable and they pay it off. And they take on some more debt and they pay it off. And they do it again, pay it off. And they do it again and they pay it off, right? 4 times, 1, 2, 3, 4, okay? The gap between these payments here is roughly about 3 months. 3 months. 3 months. Okay. So build up its debt, pay it off. Build it up, pay it off. The turnover is essentially paying it off. Okay. Compare that to Walmart. They're doing it 9 times. So what would that essentially look like? 1, 2, 3, 4, 5, 6, 7, 8, 9, whatever, something like that, right? They're building up and paying up. It's not going up to 23 billion. It's going up to 40 billion. They build up their debt to 40 billion and they pay it off. And they do it faster, more times, and therefore faster than Amazon does. So bottom line here is I look at a company like Walmart and I say, they're much better at paying off their debt than Amazon is. And that's good to know from the standpoint of an investor. I don't want to invest in a company that takes its sweet ass time to pay off its debt unless there's some sort of financial motive to hold on to it. There's no need to hold on to that cash. Pay off your debt because it could very well be that if a company is taking more than 30 days to pay off its debt, it's missing out on an opportunity to take off 2%. Remember, 210 net 30. If Amazon's offered 2% discount if they pay off their debt within 10 days, Amazon for sure is not taking advantage of those credit terms. Neither is Walmart, potentially. But more to the point, you might be familiar with this notion of late fees, right? If you delay paying your bill, right, you go past the 30-day grace period, they can start charging you fees. If you're, say, like, 31 to 60 days old outstanding. I don't want to invest in a company that's potentially incurring late fees for making payments on its debt. So this doesn't make sense to me why Amazon would take so long to pay its debt unless it was able to avoid any late fees and also in the meantime using those 90 days to invest that cash. If it's investing its cash, it's using think about this, it's using somebody else's cash to earn interest income and dividend income. That just seems wrong to me. Pay the supplier if you got the cash. That's my point of view. But that's more of an ethical concern. I just wanted to show you guys how these ratios play out.